You're losing money every single day and you don't even realize it. Not because you spent it, but because someone quietly reduced what it's worth. Every year, every paycheck, every dollar in your account buys less. You work harder, but prices rise faster. Groceries, rent, fuel, education, all up. But your salary, it lags behind. They call it inflation. But what if that's not an accident? What if it's built into the system? A feature, not a flaw. And here's just the unsettling truth. It has been designed that way for over a century. Stick around, because by the end of this video, you'll see why inflation isn't a mistake of economics. It's the backbone of a system that ensures you never truly get ahead. Before we get too deep into how your money is quietly eroded, I want to know something. From which country are you watching this video, and what time is it right now where you are? Drop your answer in the comments. It helps us see how inflation plays out differently across the world. Now, if you're new here, hit that subscribe button and turn on notifications. This channel breaks down the financial stories your textbooks skip. We turn economic puzzles into stories that make sense, because understanding money isn't just smart, it's survival. All right, let's start at the root of the deception. Inflation sounds like a natural phenomenon, like the weather, something that just happens, but it's not. Inflation is policy. It's created, maintained, and manipulated by central banks. Think about it. If prices keep going up and your wages don't, someone's benefiting from the difference. That someone is whoever gets the new money first, usually the government and the financial system that supports it. When new money enters the economy, it doesn't hit your wallet first. It flows through bond markets, banks, and asset prices. By the time it trickles down to you, prices have already risen. You're buying with diluted dollars. This design goes back to a single turning point, 1913. That pause isn't the year the Federal Reserve was born. The Fed's original mission was to stabilize the economy. But over time, its real function became clear: to make sure debt never stops expanding. Because in our system, every dollar is born as debt. That's not a metaphor. Money is literally created when someone borrows. When you take a loan, when a company issues bonds, or when a government spends more than it earns. That's how new dollars appear. To keep the economy growing, debt must grow. And for debt to stay manageable, you need inflation. Why? Because inflation reduces the real value of old debt. Governments love inflation. It makes what they owe easier to pay back with cheaper dollars. You might wonder, if inflation is so destructive, why doesn't anyone stop it? Simple. Stopping inflation means stopping the flow of easy credit. And that means crashing asset prices. Think about your house, your stocks, your savings account. They're all priced in inflated dollars. Take inflation away, and the illusion breaks. The system depends on ever-rising numbers to stay alive. That's why central banks target around 2% inflation every year. Sounds modest, right? But at 2% annual inflation, your money loses half its value in about 35 years. In other words, if you save $10,000 today, it'll buy what $5,000 buys now when you retire. That's not an accident. That's design. Let's look at a practical example. Imagine you work hard, save up $100,000, and park it in a savings account. The bank gives you a 1% interest rate, but inflation runs at 3%. Every year, you lose 2% in purchasing power. In 10 years, your savings are worth nearly 20% less in real terms. The bank, meanwhile, loans out your money at higher rates, and the government taxes the interest you earn, not the inflation you lose. The result? You get poorer for saving responsibly. Inflation punishes savers and rewards borrowers. It pushes you to spend or invest, feeding the system of debt and consumption that keeps it spinning. Now you might ask, who wins in this setup? The answer is simple: the ones closest to the printing press. When governments issue new bonds, when central banks buy them with freshly created money, that cash goes first to financial institutions. They invest it before prices rise. They buy assets, stocks, real estate, commodities that appreciate with inflation. By the time this money filters down to wages, it's already lost value. This is known as the Cantillon effect, named after an 18th century economist who noticed that new money benefits the rich first. Inflation is not equal. It's asymmetric. It rewards the few at the top and erodes the earnings of everyone else. Historically, societies that allowed money creation without restraint saw wealth concentrate and collapse follow. Rome debased its silver coins. France printed assignats until bread cost a fortune. Weimar Germany, Zimbabwe, Venezuela, all different in details but identical in pattern. Each started by stimulating the economy with easy money and ended with chaos. The US and other developed nations may seem immune, but look closer. In 1971, when Nixon ended the gold standard, the dollar lost its last anchor. Since then, purchasing power has dropped by over 85%. The average home, college degree, and medical bill have exploded in price while wages barely doubled. That's not progress. It's a quiet transfer of wealth. Every paycheck you earn is part of this slow drain. Governments claim inflation is good, that it means growth. But whose growth? When central banks print to stimulate demand, They're inflating the cost of essentials. Rent rises, groceries climb, but tech gadgets get cheaper. So they tell you inflation's under control. It's a lie of averages. The CPI, the Consumer Price Index, is rigged by substitutions and adjustments. They say if steak's too expensive, you'll switch to chicken. That's not stability, that's survival math. Inflation forces you to settle for less and call it normal, and we're told to invest to beat inflation. But that's another trap. The stock market's inflated by the same money printing that causes inflation. When rates rise to fight it, asset prices fall. You're chasing a moving target, and the house always wins. Meanwhile, those issuing debt, governments, corporations, big banks, keep collecting fees and interest. The longer the system runs, the deeper the wealth divide grows. Inflation is not a tax you voted for, but it's one you pay every day. It's invisible, constant, and compounding. Now here's the question no one asks. What happens if inflation stops? If prices fall, deflation, debt becomes heavier. Defaults rise, the system buckles. That's why central banks fear deflation more than anything. They will print to infinity before letting it happen. And when you control the money supply, you control everything. Wages, housing, savings, even politics. Inflation isn't just economic policy, it's social engineering. Inflation keeps the economy addicted to debt. Every government budget, corporate bond, and mortgage depends on it. Without rising prices, debt burdens become unbearable. That is why the people in charge cannot afford to stop it. They talk about price stability, but what they mean is controlled erosion. That you lose value slowly enough that you don't notice. It's a managed illusion. The tragedy is that most people don't question it. They think inflation is natural, like gravity. But once you understand how it works, you see that every dollar is a claim on future labor. When those claims multiply faster than real goods and services, the result is theft by dilution. It's subtle, legal, and constant. Take the housing market. In the 1970s, a typical home in the United States cost around 3 times the average annual income. Today, it's 7 or 8 times. The structure didn't change. The land didn't move. What changed was the money. The same house costs more because every printed dollar pushes prices up. Inflation inflates asset prices first. Those who already own assets become wealthier on paper. Those who don't fall further behind. It's not productivity or innovation driving these gains. It's monetary expansion. The illusion of prosperity hides a transfer of ownership from future generations to the present. Governments rely on this. They fund spending with borrowed money. Then they use inflation to make old debt smaller in real terms. It's the oldest trick in fiscal policy. During and after major wars, countries print heavily to cover costs. Citizens think they're richer because wages rise, but prices rise faster. After World War II, U.S. inflation wiped out nearly half the real value of federal debt. The same story repeats worldwide. The losers are those holding cash or fixed income savings. Bonds, pensions, and savings accounts all erode while governments boast about growth. You may hear that moderate inflation encourages investment. In reality, it pushes speculation. Investors rush into assets not because they're productive, but because they're scarce. Art, land, crypto, anything that seems immune to dilution gets inflated. Bubbles form, crash, then form again. Each cycle transfers wealth from latecomers to insiders. Financial media calls it market dynamics. It's manipulation wrapped in jargon. Central banks pump liquidity, markets rise, insiders sell, then policymakers pretend to fight the very inflation they created. When they raise rates, ordinary people lose jobs, but the wealthy already shifted profits offshore. Now, consider wages. Policymakers brag when paychecks grow, but they never mention that real purchasing power often falls. In the past 2 decades, nominal wages rose about 60%, while living costs rose 90%. That's a stealth pay cut. Workers run harder on a treadmill that speeds up every year. Inflation breaks the link between effort and reward. It turns labor into a commodity priced by policy, not productivity. The incentive to save vanishes. People are pushed into debt for education, housing, and healthcare. Debt becomes identity. You don't own your life. You rent it from lenders. The irony is that most people trust the very institutions designing their poverty. Central bankers appear calm, authoritative, speaking in technical language. They promise soft landings and data-driven policy. But their true mandate is to preserve the financial order, not protect your savings. Every rate hike or cut is engineered to maintain control over credit flows. Inflation targeting is their excuse to keep manipulating interest rates, which in turn steer the entire economy. It's a command system disguised as free markets. Look at quantitative easing after 2008. Central banks created trillions of dollars to buy government bonds and mortgage securities. They said it would help the economy recover. What it really did was inflate asset values. Stocks tripled, luxury property soared, but wages stagnated. By 2020, the richest 1% owned more than half of all global wealth. The top benefited not from genius, but from proximity to new money. When the pandemic hit, even more cash flooded markets. Stimulus checks gave a brief illusion of equality, but inflation soon clawed back every gain. Prices surged, savings melted, and inequality widened again. This system thrives on short memories. Each generation inherits a weaker currency and thinks it's normal. Your grandparents bought homes with one income. Your parents needed two. You might need debt that lasts a lifetime. Inflation shifts expectations quietly. What used to be affordable becomes a luxury. Governments point to GDP growth as proof of progress, but GDP measures spending, not well-being. Inflation inflates GDP too. It's a statistical trick that hides stagnation under bigger numbers. Now, ask yourself why the financial system resists deflation so fiercely. Because deflation rewards savers and punishes debtors. It reverses the flow of power. When prices fall, the purchasing power of money rises. Governments would have to tax or cut spending instead of printing. Corporations would need real productivity to profit. The leverage pyramid would collapse. That's why policymakers treat mild deflation as a crisis. They prefer perpetual inflation, an endless cycle of erosion that forces economic activity at any cost. Some argue that mild inflation encourages innovation. But innovation thrived during periods of stable or even falling prices, like the late 19th century. When money holds value, entrepreneurs compete on quality and efficiency, not speculation. Inflation distorts signals. It makes it impossible to tell whether rising prices reflect scarcity, demand, or monetary expansion. That confusion breeds misallocation. Entire industries rise and fall not because of merit, but because of monetary tides. You might wonder whether there's an escape. Gold once provided an anchor, but it was cut loose in 1971. Cryptocurrencies attempt to restore scarcity through code, yet they remain tied to speculative markets. Real stability requires discipline. Governments spending within means, central banks limited to genuine emergencies. That discipline disappeared a century ago. Today, every crisis is solved by printing. Each rescue plants the seed of the next bubble. Inflation is cumulative. Once expectations shift, reversing them is nearly impossible without pain. Consider the generational divide. Older investors who bought assets decades ago benefit from inflation. Their homes and portfolios rise in nominal terms. Younger workers face inflated entry costs. They rent longer, save less, and rely more on credit. The result is resentment and polarization. Inflation doesn't just erode money, it erodes trust. People lose faith in fairness, in institutions, and each other. When prices outpace wages, social cohesion breaks down. History shows that sustained inflation often precedes unrest. It's a quiet trigger for revolutions. The current decade echoes the 1970s. Supply shocks, rising deficits, political gridlock. Back then, inflation peaked near 14%. Today's official numbers are lower, but real inflation, including housing, food, and education, feels worse. Central banks pretend it's temporary. They'll raise rates, cause a slowdown, then declare victory once prices stabilize at a higher level. You'll still pay more for everything, but they'll call it success. That's the trick. Inflation never reverses. It resets the baseline. Each reset transfers wealth upward. Those holding assets ride the wave. Those living paycheck to paycheck drown slowly. The media calls it a cost of living crisis. It's not a crisis, it's policy. Inflation isn't the byproduct of incompetence. It's the foundation of modern finance. Without it, the mountain of debt would crumble. The people who design money know this. They talk about fairness, but their system demands losers. You're meant to work, spend and owe, forever. Inflation's deception lies in its invisibility. You don't see your dollar shrink, you only see prices climb. By focusing on goods, not money, the system hides blame. Every government blames external shocks, but the cause is internal. Too much credit, chasing too few real goods. Until that balance changes, your money will keep losing value while they call it stability. So, where does all this lead? Imagine standing at a crossroads. One path continues the same cycle of debt, inflation, and diminishing value. The other demands a reckoning with truth. Most people, understandably, take the first path. It's easier to believe the illusion. You see your paycheck increase, your house appreciate, your stock portfolio rise, and you feel wealthier. But here's the hard truth. If everything you own is priced in a currency that's losing value, your wealth is just running in place. It's like standing on an escalator that moves downward faster than you can climb. This isn't a conspiracy, it's a design. Inflation is a built-in feature of modern money, engineered to ensure that people keep borrowing, keep spending, and keep fueling economic growth, no matter the cost. Politicians love it because it makes their debt cheaper to pay back. Central bankers defend it because it keeps their system stable. Corporations benefit because they can raise prices and claim record profits. But what about you, the saver, the worker, the dreamer? You get the illusion of choice, but not control. Let's go back to the source, fiat money. When currencies were backed by gold or another scarce asset, printing was limited by reality. You couldn't create gold from thin air. But after 1971, when the U.S. decoupled the dollar from gold, money became an idea, a promise of value, not value itself. Governments discovered they could spend without constraint, and central banks learned they could manage entire economies with interest rates and digital printing. The result? Every dollar, euro, or yen today is a claim on trust. And when trust weakens, the illusion trembles. History shows what happens next. Every major fiat currency has eventually failed. The Roman denarius, the French assignat, and the Weimar mark all ended in collapse once printing outpaced production. The timeline varies, but the outcome is always the same. Confidence evaporates and people rush toward real value. Gold, land, food, or foreign currency. Inflation doesn't destroy value immediately. It corrodes it gradually, then suddenly. The final act comes when belief breaks. And here's where it gets darkly poetic. Inflation is invisible, but hyperinflation is unmistakable. When prices double every few days, people stop calculating. In Weimar Germany, wages were paid twice a day because morning pay couldn't buy bread by evening. In Zimbabwe, trillion-dollar bills became worthless overnight. In Venezuela, entire savings vanished before payday. And in every case, governments blamed greedy businesses, foreign speculators, or supply shocks, never their own printing presses. You might think this could never happen in modern economies, but remember, collapse begins with denial. In 2008, trillions were created to save the system. In 2020, even more were printed for stimulus. Each rescue normalized the unthinkable. Now, we live in a world where central banks move markets with a single sentence, and entire generations are priced out of basic needs. Inflation may not yet be hyper, but it is structural, a permanent part of our financial DNA. There's a saying, if you owe the bank $1 million, that's your problem. If you owe it $1 trillion, that's their problem. Governments today owe hundreds of trillions collectively. Inflation is their escape route, a silent tax on savers that allows them to repay debt with cheaper money. You work harder, save diligently, and lose quietly. It's the most elegant heist in history, and most victims never realize it happened. But here's the hopeful side. Awareness is power. Once you understand that your currency is designed to decline, you can adjust your strategy. Savers of the past hid cash under mattresses. Savers of the future must think differently. Real assets, land, commodities, productive businesses, hold value because they produce something tangible. Knowledge, too, is a form of currency that inflation can't touch. If you understand the rules, you can play the game instead of being played by it. Still, we have to ask the uncomfortable question, can this system sustain itself forever? The answer lies in trust. As long as people believe their money has value, it works. Once belief falters, when inflation erodes living standards beyond tolerance, people seek alternatives. Cryptocurrencies emerged from this mistrust. Decentralized finance promises transparency, but it also inherits volatility. Gold remains the timeless fallback, yet even it cannot fix broken discipline. Real reform must come from restraint, something our political and financial leaders have long abandoned. In a way, inflation is the language of empire. The British Empire expanded through credit, the American Empire through the dollar. Each superpower used its currency to project influence, but every empire that debases its money eventually declines. When Rome mixed base metals into its coins, it didn't just lose silver, it lost confidence. Inflation corrodes not only wallets, but world orders, and the signs of decay are visible now. Rising debt, falling trust, and growing inequality. So, what happens when people finally see the game? Some will panic, some will adapt, and a few will profit. Those who control credit, the lenders, asset holders, and policymakers, will always find a way to stay ahead. But the rest of us can reclaim power through understanding. Inflation hides in plain sight, but knowledge reveals it. The next time you see a headline celebrating rising GDP, stock records, or wage growth, ask, and what money? If everything is measured in a shrinking unit, are you really richer? Or just distracted? At its core, inflation is not an economic phenomenon. It's a moral one. It rewards consumption over saving, speculation over work, and deceit over honesty. It teaches societies to value short-term gains over long-term stability. A civilization that forgets the meaning of value soon forgets the meaning of trust. And once trust collapses, no printing press can restore it. If you've made it this far, here's a thought. Every empire, every currency, every era believed it was different. They said, this time it's under control. But money, like truth, cannot be bent forever. You can hide its decay with clever words, statistical tricks, and policy jargon, until one day the illusion cracks. When that day comes, history will not remember the excuses. It will remember who saw through them. So, tell me, do you think inflation is an accident or a design? Drop your thoughts below, and let's see what people from different corners of the world think. If you found this breakdown eye-opening, make sure you hit that like button. It helps more people discover the truth behind the numbers. And if you want to dive deeper into how